Jared, episode 17 of Your Wealth Playbook. We've got some exciting guests on for any business owner, property developer, self-managed super fund, a couple of accountants, Brad and Andrew from Kindred Accounting.
We sure do. This is a really exciting one to go through how an accountant and a really good accountant is a partner in business, partner in planning, going through the fact that there's no walls between them and their clients and what their ideal client looks like and how they can help them succeed in business.
Andrew has grown the business from just himself as a solopreneur 7 years ago. Kindred Accounting is coming along, but more importantly, where they help clients, business owners, anybody who's looking, for accounting work that is a small business, that are property developers, or may have an interest in a self-managed super fund. The boys have got some great knowledge behind them as well as their entire team.
A bit about how they've grown as well and their journey from being a solopreneur to a team of 10 plus. So let's get straight into it.
Just a reminder, the information in this podcast is general in nature and does not take into account your personal objectives, financial situation, or needs. Before making any financial or investment decisions, you should consider whether the information is appropriate for your circumstances and seek professional advice. Past performance is not an indicator of future performance.
If you'd like to discuss any of the points mentioned today in more detail, reach out to us directly and we would love to help and have a chat. Brad, Andrew, thank you for coming on to Your Wealth Playbook today. It's a pleasure to have you both. You've worked with countless small businesses and growing businesses over the period. Andrew, I think that you've been an accountant now for nearly 2 decades.
Yeah, we don't have to talk about it, just how long it's been. It's been a while.
Brad, for you, 15 years or so?
Yeah, very close to 20 as well, so getting there.
Yeah. What separates from the businesses that scale and keep growing to businesses that stay stagnant?
I think there's a few factors. One's definitely leadership, that ambitious drive to really push a business forward and to get somewhere. That's massively going to set apart a business that is going to scale from one that isn't. And I also think you can't scale a business by yourself, right? Like, you've only got your own time. It'd be really, really hard. Maybe if it's a product business, but even then, it's really hard to scale with just you. So the next scale factor is people. So a business that puts its people first, focuses on building the right team early on, is going to be miles ahead. And even if you change the direction of the business, if you've got the right people on your team, you're going to be hitting that speed that you want to, right? They're going to be driving a lot faster than someone else.
They call it the A players, or making sure you get the right people on your team, which I'm sure that you've heard of before. How do you make sure that, one, you're not the limiting factor in the growth of the business, that you're probably pretty entrepreneurial, probably, pretty driven, but then if you are like that, it can be very hard to let somebody else in to help drive the bus.
Yep. So when you're thinking about what it takes to be a great leader in your business, it's that balance between ambition but not ego, like having that humility in there and understanding. And I've heard Shelley Johnson talk about this, leadership as it's a service, right? You're serving the people who you're bringing onto your team. So you want to look for ways to empower them and to really make sure that they have the best chance of succeeding in the thing that you guys are building together.
Ego. How do you get someone to drop an ego?
No, mate. Is it about convincing someone to drop an ego, or is it about identifying the people that don't have that ego thing in the first place?
I think we've probably all got egos, and I was with a great advisor who was talking about it, and he mentioned, everybody's got egos. But when you're working a part of a team, and I've seen them, some high-performing teams, some not so high-performing teams, everybody's got an ego. But if you can work in a culture that parks that ego at the door and gets that team environment to move forward or to step forward. But it's so hard in business because, especially if you've started the business, like you, Andrew, to bring somebody else in.
Yeah.
How do you work with the founder in that aspect and go, listen, I think that, 1 + 1 is 3 in this instance.
Yeah.
How do you find that right team member, or how do you find that right person?
Yeah, I think working with a founder, you want to identify what their true strengths are and where is the best place for them to be investing their time in the business. Because again, like time is it's a completely finite resource. You only have it so much. So if you can find where's going to be the best return on them investing their time in their business, how are they going to resource the other areas of the business that are still important, still need to be done, bring in some people who are really good at those, but where are they getting the best bang for their buck? Is it early on? Is it that they're the growth person? Are they a really good salesperson? So they're going to oversee that aspect and then find someone who's a really good operator to make sure the machine that comes behind making the sales is actually getting the work done. Yeah.
Do you find that really easy to identify now after dealing with so many people and so many successful businesses, that you find it easy to identify what type of person and what type of leader that is when you meet them?
Yeah, I mean, I wouldn't say that I'm a massive specialist in bringing that out of people, but I've definitely found it a lot easier over the years from dealing with lots and lots of business owners to help spot it and to kind of gently steer people in the right direction.
Now, Andrew, you talk about dealing with the trailblazers and the entrepreneurs of setting up the business. What's a financial red flag that you spot early on? Because quite often, we'll speak from personal experience, the entrepreneurs are not always the best when it comes to being the chief financial officer, and sometimes the grand plans don't always marry up with what they can do at that point in time. How do you spot those red flags, and how do you help get them through to what their ultimate goals are there?
Yeah, we don't always have the opportunity to spot them, and what I would encourage someone in that early stage to do is to be really self-aware of, are you keeping an eye on the numbers and the financial stuff? Because sometimes there's this avoidance that creeps in where they might know that one part of their business isn't really functioning like it should, but they'll just focus on what is working, focus on the good stuff, rather than being honest or, opening up the books to a bookkeeper and accountant and saying, hey, give me some feedback. What's going wrong here? So I think just be self-aware. Are you avoiding the real underlying issues in your business, and do you need a bit of help?
Is that something that you will sort of press within that first 12 years and part of, I guess, the infancy and the coaching of it, to make sure they are upfront and honest with things there, because it is about prevention rather than cure when it comes to business success and failure?
Yeah, I think when we're working with someone, the way we add value is understanding the context of what they're trying to do, not just filling out a tax form or an activity statement. Like that's just something that has to get done. It's not really moving anyone forward, but understanding the context, the goals, where they're heading, and then making sure that they're actually making some progress towards those things. So having regular conversations with them and keeping them accountable.
Pretty critical to know your numbers in business.
Yeah, it is.
What works well, what doesn't, because it's similar to a household that if there's more going out than what's coming in, you're going to run into some problems.
Yeah.
And I'm pretty sure that you guys, one of the biggest problems that people will run into when they first do start running a company is tax problems.
Yeah, so that is sort of a red flag we see, is when your tax bill comes as a surprise for you. You're going through and then your accountant sends you like your BAS or your income tax bill, and it's like, oh, I wasn't expecting that. It's way more than I was thinking it was going to be. It just shows you that, hey, you need to be a bit more across the numbers, what it's actually doing, where the cash is actually going. So spend that extra 10 minutes on the phone with the accountant or reflecting on with yourself, knowing, hey, this is where the money's been spent. This is why I don't have the money at the moment. Sometimes you find when you're saying with entrepreneurs and people starting up, they'll come see an accountant when you're 6-12 months down the road. And by that time, you've had 6 or 12 months of spending all the money and realising you've overspent. And then the next 12 months is even harder because you're paying tax from last year and then the current year's tax as well. So it's a bit of a juggling act there.
So the killer's not it's not the tax itself, it's the planning for that cash flow.
Yeah.
And all of the tax parts you can easily forecast it. You can work out what it should be. It's not rocket science. Like people think Brad and myself are mathematicians. Accounting's like a high school maths at best. It's all really easy. We just understand how the puzzle pieces fit together. So if you can get someone to help you to work out what your tax payments are going to be, you know about it in advance, you can plan for it. It's easy.
And even now, like you have a look at online banking tools that, you know, business bank accounts will offer in terms of, you know, cash flow and looking at trends and, you know, period, you know, here versus there and year on year. There's lots of ways that people can help themselves and self-educate when it does come to that sort of stuff now, which will then ultimately make your job a little bit easier in that aspect, and you can focus on the stuff that's then truly going to add value to them.
Yeah.
I think the biggest piece of advice that I got from you two when I first started working is that all of your income is not all of your income, especially if you're earning over $75,000, because you need to give 10% of that to the government in GST. But also, if you're paying yourself a wage, then you've also got, you know, a portion of that needs to be withheld because you need to give that away as well. And that's how tax does work when you are paying wages and employees and the likes, which people don't understand. But the biggest piece that I got was 30% of all of your income, put it away, because that's generally around what your tax bill is going to be. And if you've got that sitting there aside by the time that we do your BAS, you've got the income there to pay your BAS and you're not chasing your tail.
Yeah.
So don't spend all your money that comes in because it's not all yours. You've got to give it back, or a portion of it anyway. Is that something that you will tell, you know, founders or starting out with, you know, we need to set money aside for tax?
Yeah, absolutely. Having that buffer there will give you peace of mind knowing that you can see that growing, and when the tax bills do arrive, that you've got that ability to pay it and not lose any sleep over it, essentially.
It'd be nice if when you got your ABN number, they also gave you a little bucket that you could carry your tax around in as you're collecting it for everyone. Business owners don't get much thanks from the government for carrying the load of being the tax collectors, do they?
You essentially are. You fit the nail on the head that most business owners don't understand that, you know, I just thought that I pay the tax personally. Well, the actual business has got to withhold that.
Yeah.
And they've got to pay that quarterly. And if you've got 5 or 6 employees, that number can stack up week to week.
You got super as well, and there's other requirements from the state government as well.
Yeah, it's nice. Are you working on with the government to get a little bucket for everyone and say this is you
I
are
don't
the
know
debt
if
collectors
they'll
for
go
us?
that. Maybe a T-shirt or a hat.
A pen, maybe.
A couple of
Tax
pens.
collector.
Yeah. Talking about, you know, tax, we've just been through the end of financial year now, and I know that you guys go through a tax planning meeting, and I'll talk with business owners, and I'll have, you know, a question I will ask them is, have you done a tax planning meeting with your accountant? And a lot of the answers is no. I know it's something that you guys focus on. Why do you focus on tax planning for the end of the year? And what should business owners, more importantly, be focusing on for tax planning for the end of the year? Yeah,
so we build that into every relationship that we have working with clients, is that tax planning's part of the basics. And it's important because if you don't do that, you're going to miss opportunities before the end of the financial year. You might forget about your ability to put a bit extra in a super. You might not review your balance sheet and pick up on opportunities there. Like you're going to leave cash on the table if you don't plan for it. But the reality is that work that we do in the last couple of months is really just the last check. It's like ticking the boxes and making sure that we've done the paperwork and your dividends and your trust distributions are all documented. But your tax planning happens all year. And it's even more important now that we're in the world of single touch payroll, where your payroll is getting reported to the tax office every week, every fortnight, rather than just as an annual thing. So you need to be setting up your structures and your wages in the most tax effective way all year, not just a little fiddle that you can make at the end of the year. Like, that doesn't work anymore. That's why it's part of just the basics that we do.
Yeah, and it's also like every year can change for clients. So some years they want to save tax, other years they might want to look for investment or growth. So it's just like, how do we make sure the structure is best set up to finish the year well? and so that you can get the outcome that you want. Because after 30 June, it is what it is, essentially, nearly. So you want to be able to put yourself in the best position for what you want.
If you're having a tax planning meeting after June 30, good luck. There's nothing you can do at that stage. But Andrew and Brad, you spoke about structures, different sorts of structures that are available to business owners, because if you're not just a PAYG or an employee, you just get hit with your tax. But if you are a business owner and you have had a cracking year, and I hear the stories all the time around, I want to pay no tax in my business. I want, what expenses can I have, or, what truck or car or what tools or equipment do I not need, but it's going to save me paying tax. So instead of paying it to the tax man, why don't I go and get the new Ford Raptor for 150 grand?
Yeah. Well, it seems like we're coming to the end of that period of time where the government was encouraging people to go and spend lots and lots of money, and all that ads you'd see on TV were like, come and get your tax write-off here. I think that to some extent that did encourage people to make bad decisions, because it was prioritizing the tax effect over the commercial outcomes. So people might maybe buy, like you said, a Ford Raptor just to get that tax break. But does it really make sense for your business? Is it the best time to be turning that vehicle over? Is that going to help you have the lowest cost of ownership of that equipment over the lifetime that you're using it? I'm sure there are loads of people who bought stuff that they didn't need and things that didn't help their business earn a greater profit the following year.
A lot of the times they've bought a depreciating asset that helps the business no end or grow the business at all. It was just for a tax, purpose. And if you are looking to do anything, borrowing, it might be for a family home, or it might be a commercial property that you're looking for. If you haven't paid tax and a bank goes and looks through, Jared will be able to talk through more on this, but if the bank goes through and goes, there's no profit in this business, where do you think that you're funding your new $1 million or $1.5 million, purchase or property purchase from? There's no income in this business. And you go, well, no one told me that. I've got my Ford Raptor though.
Yeah.
How's this look? And it's understanding that tax implications, or buying an asset just to miss tax is not always the best. And I know that you're big proponents of not doing that.
Yeah.
Especially if it's not going to further the business.
What opportunities do you pass up when you buy that asset? So if you've gone and got a big new loan for your Ford Raptor, and then you want to add another team member into your crew, suddenly you're trying to buy another vehicle. Maybe the bank's saying, no, you don't have the ability to service that new loan. You're like, well, gee, I wish I didn't splash out so much on my car so I could have another vehicle on the road and another person earning money for the business.
You set a high bar as well, because they want the Ford Raptor.
They do, yeah.
You also touched on structures for business owners, that are employing a couple of people. If they own the business solely and there is profits to come through, is that the best structure to hold their business entity in personally?
We would encourage anyone who's employing a few people, carrying on a business, to probably look at a company structure, just as a general rule of thumb. But it's a case by case thing. You sit down and go through your circumstances, what's going to work best for you.
Yep. Probably how long that business is going to operate, what your goals are out of the business. There's a lot that goes into what structure you should operate or be operating a business from. Yes. Property development is another one that you guys would work with, I would imagine. Property developers often underestimate the complexity of financing, which we've just spoken about. What's the biggest tax or structuring mistake do you think that if someone was going to go and develop property that they make, and it's probably after they've probably gone and got the property acquisition or gone and done it before they go and see their accountant?
Yeah.
Already paid the stamp duty.
That's a big one.
Lots of traps when it comes to property development or just individual property transactions. You've got GST things to consider. Is GST going to apply to the sale of the property I've developed? How is the tax office going to look at this transaction in terms of, is it going to be treated as capital gains income, or is it going to be treated as business income from carrying on a property development business? Those things can give you different outcomes on the tax side. So there's lots of stuff to really work through in the feasibility stage, right at the start of the project, that your accountant won't be able to help you with right at the end. They'll be able to tell you how the rules apply, but they won't be able to help you change anything. Get involved early on.
And I think also having the end in mind as well. Is this like a one property project? Is it something you want to grow further? Do you want to do it on your own? Do you want to do it with other people? So it's always good to have the end in mind. So when you've set up the structure, that it finishes as well as it starts as well.
There's plenty of times that we'll see a client, they'll just come in and it's as simple as I want to do a development. There's not a lot of thought behind it to start with. And all they see is the construction cost and the land acquisition and the sale price. They miss everything else in the middle of the feasibility. What are the 3 questions that you'd then ask at that point to then hopefully steer them in the right direction to get the best outcome?
I'd be asking about, so what is it, like the actual details of the development project? What are we buying? What are we trying to sell at the end? Question 1. Question 2, how are we funding it? So do we have some approvals, or are we confident of getting approvals to be able to fund what we think the expected costs are going to be through the whole project? And question 3, how are you going to fund it when it hits the fan and it doesn't actually go the way you think it's going to go? Because cash flow is the killer in these sort of things. If you run out of money, you're trying to sell a project that's not finished, you're not going to get what you want for it or what you deserve for it. You're going to be taking a auction value for what you've done so far.
Another question to think about is also...
Fourth bonus question.
Yeah, fourth bonus question is, why are you doing the project? Is this the best use of your time and money? So if you're, I don't know, if you work in the health profession and you're a physio or something, you want to all of a sudden do a property development, if you've got $500,000 spare, is a property development the best use of your money, or could you be investing it elsewhere?
Are you
getting the same return?
Are you operating in your zone of genius?
Yeah. Or you just saw your mate at the pub doing it and thought, oh yeah, he's making good money, I could do the same thing.
Brad, I'm a school teacher though. Yeah. I reckon I can develop, 3 townhouses on this lot. That's pretty easy to go and do. I've already bought it.
Well, it makes sense. You can wrangle like 30 kids. So, hats off to you if you can do that.
You spoke about, going through with, property developments and the likes. Cash flow is obviously going to be king with everything that you do with lending, with borrowing capacities. And it's something that a lot of people won't, look into with any depth. If you put it into structures, there's different obligations. If you're doing it with different directors, there's different obligations around what their personal circumstances are likely to be. They might already be tapped out. It's not just as easy as going, from a residential place that, I'm going to go and add 200 or 300 grand to this. Someone will give me 200 or 300 grand. Might be that no bank will give it to you. You then go and look for a third or second tier option. Then the interest rates are obviously higher. Then that hurts the cash flow even more. Then you're under time constraints. Then weather plays into it. So it's a whole piece and puzzle around if you are trying to build or do property development. I think what you're trying to say is have the right plan in place, and more importantly, probably have the right team in place to help guide you through, especially if you're a school teacher.
Just listening to you talk through that, there's so many factors that are outside of your control. Are there other investments you could be looking at that give you a similar return where you can control the outcome?
Yeah. My mum always says, I don't know how true it is, but only bet what you can afford to lose. So if you're very risk adverse, that's probably some good advice.
Yep, absolutely. Talking about a different structure though, self-managed super funds. Are they still worth it in 2025, do you believe?
They're worth it in certain circumstances, right? Like, I don't recommend yes or no to people when they ask me about self-managed super funds, because I don't want to get a smack on the bottom from our corporate regulator, ASIC. I'm not a licensed financial advisor, so we rely on guys like you, Kerrod, to do that final, yes, this is going to work for the outcome that you want. But just speaking generally, I think they still work for you if you want to do something specific, maybe a commercial property, you want to be your own landlord. It's really nice not to have an external landlord to deal with and have comfort knowing that you can keep running your business from the place that you own. Or for people who want to invest in something really specific or just want to have really tight control of their own money. But you could probably speak to this as well. I think a lot of the other investments that people should do or could do are all available in the retail super environment at a much, much lower cost than a self-managed super fund.
Yeah, you touched on it, who SMSFs are really good for. You know, it'll be your business owner. If someone wants to get specific, have control over what they're doing for their retirement savings, which you can do, it's generally the first question that I'll ask somebody when they want an SMSF is why and for what purpose, and, you know, run them through a whole list of cost, going through, you know, a cost analysis with them, because I'll probably try and talk people out of SMSFs as much as possible rather than talk them into it. Yeah. I get paid more if people set up SMSF, so it's not in my best interest, but I don't work just for me, I work for the client. So it's, you know, obviously in the client's best interest in what that looks like. And people just, you know, it'll be the pub test. I've heard down the pub that I can go and stick 2 or 3 investments or properties, and properties always go up, and I'm like, okay, there's other structures you can do that into. You don't have to just do that in an SMSF. And if you're just after a gain, or there's other things that we can go and put into, you touched on it, retail products. Tell me, and you've probably seen these as well, horror stories with SMSFs. And what have people got in there that you just shake your head at and go, what are you doing? What is in an SMSF?
Can I put my whole super into altcoin? Is that doable?
I've had one client in a previous firm that had a gold bullion.
Yep.
And instead of having it in the proper places like in the government, wherever, he had it in his backyard, buried in his backyard. And so part of the audit process
what was his address?
You had to try and prove that you actually had it. So what you do is dig it up every year and put a newspaper there and take a photo. Look, it wasn't great for the audit process, I can tell you that. So yeah.
Wow.
Yeah, I mean, I've seen diamonds. I don't know if they were terrible, but not a conventional investment. It's certainly not earning you an income stream.
Yeah.
You're relying on capital growth of rare gems. Good luck.
Oh yeah, of a rare gem, and some of these sorts of things you can, not diamonds specifically, but if you want gold, you can go and own gold through any number of ETFs these days. Gives you access to it. There's probably some even industry funds that would allow you to invest in gold if you really wanted to. So.
I'd like to see Pokemon card. If anyone's got a self-managed fund with a Pokemon card, reach out.
Is that you want to go and own a couple?
Just be a good story.
Yeah. I mean, the big one these days is people own, you know, crypto through an SMSF, or they'll go and start it. And a big thing with me is if you want to go and start an SMSF and you want to go and own crypto, I'm probably not the advisor for you. There's 15,000 advisors in Australia. You might find one that'll do it for you, but I'm not the person for you to go and invest your retirement savings into something that's highly volatile. Can you walk us through a powerful SMSF strategy where it does work for someone? We spoke about the negatives and what it's sort of not to do, but they can be pretty powerful when done the right way.
Yeah. Okay. So you and I worked on recently for someone who is less than 10 years away from retirement and already owned a couple commercial properties personally. They were looking at acquiring another one, and they were just thinking they'd add it to their personal property portfolio. I got chatting to them about that before they'd signed contracts and anything, just early stage, and said, hey, have you thought about putting that into superannuation? And sent them to you to kind of run through the numbers and work out how it would all fit together. And that would be saving them tens of thousands of dollars in retirement, because once they start taking an income stream from their self-managed fund, the tax rate on all that investment income on those commercial properties becomes nil. So it's working out really, really well for them, and we were able to manage getting those assets into super within the contribution limits, how much you can actually put into super each year.
it did work amazing, and you're exactly right. If you've got, property in your own name and you want to hold it for the long term and you're getting closer to retirement, tax perspective, I think is what you're talking about there. Well, obviously what you're talking about there is the rental income on anything that you hold personally, you're going to have to pay tax on. And if it is substantial because you've got a commercial property and let's call it, for Bushmass, $100,000 a year, if you and your partner own that, it's $50,000 worth of taxable income each and every year. I don't know the specific tax rates, but it's probably $7,000 to $8,000 each year on $50,000 worth of income. And, it's $15,000 a year. For 20 years, that's $300,000 in your pocket rather than the government's coffers. So I think it's a pretty good strategy that can be quite powerful for you long term.
Yeah. And the key to building long-term wealth, the secret to that is in the phrase, right? Long-term. It's not going to happen in a single transaction. It's going to be built over 10, 20 years of doing things that consistently help you get a good income.
Yes. Can be quite powerful. And you touched on it there, the pre-planning.
I was just about to say that, the proactive approach as opposed to the reactive. And that's the difference there, that if you can have a look at something and see that there are opportunities to help up front, that's where you're getting the most bang for buck out of using a good quality accountant there.
Yeah. And I like that people feel comfortable picking up the phone to talk to me about stuff like that because we don't bill them by the minute. So if they make a phone call and want to ask a question, we're not going to send them out an invoice at the end of the month. It's all kind of built into our arrangement. We provide support and we're happy to talk to people because we want to pick up on stuff like that.
Yeah. Yeah, absolutely.
That's an amazing arrangement from a service-based business that you guys have got the foresight. There are other service-based businesses that don't operate that way and you are hesitant or scared to send them an email because you're like, Jesus, what's this bill going to take?
Yeah.
Then you might miss out on, in this specific instance we're talking about, it could be $300,000 worth of tax obligations, So
or just assuming what you've done in the past is what you should be doing because you've got a track record of holding, two other assets that are exact same. That difference between I do it already, it should be fine versus is this fine? Are there other ways to do it? I think that's really powerful.
Yeah.
You spoke about that model. I would obviously, going back to being a business owner, if you are not just working on billable hours and you are actually, partnering with people and there's, a pay for a service, I would imagine that from a cash flow point of view, as an accounting service, it probably works well for your business.
Yeah, it works well for us to have that smooth cash flow cycle and for our clients to understand exactly what they're up for. No surprises.
No surprises, accountants have got a good cash flow model that they're operating from into the books. Is that something that you help guide clients with as well? Saying, if your income is pretty lumpy, because I would imagine that you see in numerous amounts of businesses that their income is lumpy and you go, shit, how can we get this not so lumpy? Because this is a headache and cash flow constraints kill businesses.
Yeah, it's a conversation we have regularly. It's not always about the way the income comes in. Like having it come in lumpy isn't necessarily the problem. It's how you're using it once it's in your hands. Like if it's coming in one big lump and then you're spending it, well, that's a problem.
Yeah.
If you're managing it and making sure that cash is spread across where it needs to go, that's fine. Yeah.
We'll work through the business now. And what made you want to start Kindred Accounting?
Yeah. I left another accounting firm to start Kindred Accounting. And the reason I did that was because I wanted more autonomy. I wanted the flexibility to take an afternoon off and teach my 5-year-old how to ride a bike without feeling guilty about it. And that's a really hard thing to find unless you're running your own show. So I wanted to build a business where I could offer that to other people. And thankfully, we were blessed with lots of clients coming our way and we've been able to grow. And I met Brad, who had similar values. We met at a school birthday party, got chatting, and I could see he wanted to do that stuff as well.
Yeah, the two accountants in the corner of the party. That's exactly how it works.
That's an interesting conversation.
It really happened. Someone found me sitting by myself, not wanting to talk to anyone, just being standard introvert, and they're like, "Hey, I know another accountant. What are you going to talk to him?"
It's like, oh, this guy's completely different.
Leave me alone. That's pretty fun.
we've all got a personal reason. I think we're starting business. Was there something that you saw missing in the local landscape? You know, there was a hole to be filled from a service perspective.
Yeah, it's that barrier between a client and their accountant. Like, there's a lot of firms that are hiding behind cubicles and suits, and the people feel kind of unapproachable. We wanted to just break that down and have our clients feel like they could talk to us whenever they need us. And the balance that you've got to strike then is, who do I actually work with? Because if there is no barrier between you and the client, and you've got 1,000 clients, and that's going to be a problem. So we've got to balance it and make sure that we only look after the people who really are our ideal clients to work with.
And just setting the expectation up front, because it's just not us in the team. We've got a whole team that works together to look after you. So if I'm not here, there's like 2 or 3 other people that know everything about your business and who you are that can talk to you. So if you need something for finance, you don't need to email me. You could email Catherine, and she's more than happy to get everything you need. So it's about knowing who to reach out to for what conversation as well.
Or email all of us, and whoever's got capacity.
Yeah,
It's a great email.
yeah, exactly. Yeah.
I love those.
Now, it's obviously a great goal to have, that you want to have, you know, a couple of afternoons off, because you're then flexible and you've got that time maybe built in the evening. But starting a business isn't like that at the infancy stage.
Yep.
How did that go in terms of, you know, building towards the goal and what you've now built?
Yeah, well, the infancy stage, I had too much time and not enough income. So a mistake I made early on was saying yes to everything that comes my way. So you end up with some work that's not that ideal type of work for you. So we made changes along the way. So it's 7 years old now, and we've kind of got to a point where we're finally only working for those people that we really love supporting, which are ambitious business owners, particularly multi-business entrepreneurs or families that might have a trades business and a creative business.
Yeah,
husband and wife both pursuing their own endeavours.
that's cool.
Lovely. You've got 4 children, Andrew, as well as starting and running a small business. Time constraints, I've got no doubt why you wanted to, you know, have the flexibility to run businesses. But it probably, having the children, I think, did you mention it was at a birthday party that you met Brad?
Yeah, it was a kindergarten or year 1 birthday party.
Nice. In comes Brad, and you were probably at that stage going, I think I need some help here.
Yeah.
Over walks another accountant, and in comes Brad. Was it
With a couple of party pies at the time.
Was it a natural fit for you to just go, hey, I think Brad can come into the business and help, you know, grow this business? Is that something that you always wanted to do? And how did you know that Brad was excellent?
How could he not?
I think I always wanted to build something greater than myself, or like contribute to a business that might outlast me. I don't know if we're there yet. Hopefully I could walk away tomorrow. Am I allowed to go around?
No, not yet.
But I think that'd be really nice to have a legacy of a business that.
But as it grows, it helps encourage you as a business owner. So you've got someone else to do your ride or die with you. Helps increase your revenue, like speaking purely from a business perspective, but also helps decrease the risk, because if Andrew wants to go to Europe for 5 weeks, he can do that now, where before he couldn't. So part of our values is making sure our families are well looked after and spending time with family. So having those holidays and all that time off makes a difference. And so you can't do that on your own or do it well, I don't believe. So bringing other people around you that's like-minded helps you be able to achieve that easier.
The like-mindedness of growing businesses together, I think, is admirable from you two. But also, we are all fathers in this room. We all do run small businesses. It's very hard to go and see that person, they are going to help us grow the business. was it the party pies that Brad offered at that stage, or how did you know that? Was there anyone else before Brad, or is Brad the first
I was
attempt?
the second
or-
option.
Brad,
The other person
The
said
first
no.
guy didn't come to the party. He wasn't invited.
Brad's not my first business relationship, actually. So, and I won't speak too much about that, but I left that firm. It didn't work out fantastically, or I learned a heck of a lot there, and it was really, really good over those years, but it didn't end up the way I thought it would at the beginning, right? A lot of business relationships don't stay together, like marriages, they don't stay together. I think what you really need to look for is that alignment on values now, but also in the future, right? Like the values that you hold close right now, they might change. If you start a family and your business partner doesn't, well, your needs are going to be pretty different in 5 years' time. If you're 25 and your business partner's 55, your needs are going to be very different in 10 years' time when they want to retire and you're still going hard for growth. So, yeah, it's having that forward-looking mindset and making sure that you're aligned now and you're going to stay aligned, or you're at least going to communicate about it really well over that time.
And hats off to you, I think, because you did do it and you found out the things that worked or didn't work for you, and you didn't sort of become like that victim mentality. It's like, woe is me, and just stick your head in the sand. You realised what worked well and what you needed, and then gave it another crack, which I'm thankful for too. Yeah.
This is good. It's like a counselling session.
I get that. I've got the tissue box behind me, mate, if there's going to be some tears shed. But no, I think the lessons that we learn from success, but from failure, is probably more so in business. And it's very hard for business owners to give up control, or they may have had a bad experience and then go and put their head in the sand. So it takes someone with, resilience to go and, bat again, or to stand up and to go again. And most business owners won't. If you had to give one piece of advice now to a solopreneur looking to grow their business, what would it be?
It would be to focus on consistently taking little actions to improve your business over time, and starting with the end in mind, where you want to be. Because if you just keep making those little improvements, those little micro adjustments, it might not feel like you're making progress, but eventually you'll look up and you'll look at where you are and where you've come from, and you'll be amazed that you've actually been flying for a bit longer than you thought.
Long-term planning. You sure you're not an advisor, mate?
You got any jobs going?
Well, I don't know. If in the next lifetime, mate, I reckon you might suit this business. Yeah. What about you, Brad? If you had one piece of advice to a solo business owner?
For me, probably should have thought more about it while Andrew was speaking. I think it would be know what you're good at and just keep working at that, and don't be afraid to outsource or ask for help in the other areas that you're not good at. So if you're good at selling, sell. If you're not great at accounting, come see us. It's that kind of concept of you can't wear all hats. You try to as an entrepreneur, and you have to some extent, but when you can outsource it, do it.
Outsourcing is topical because a lot of people don't want to give up that control, or they might say that's an expense that I could do.
Yeah.
Sorry,
you go.
There's two things that I picked up from a business owner that I used to work with, and he was talking about outsourcing. And he said if somebody else can do it at 80% of that I can do it at, then I should outsource it, and I should be happy with that. No one's going to do it 100%. But when we're talking about outsourcing, and people go, I probably don't want to pay for that, I've got a saying that I live by, is that the poor man pays twice. So if you're trying to be cheap and you're trying to cut corners and go, no, this is probably a better option for me because it's going to cut me a corner, but if they're not doing the right job or not doing the right thing, you're going to end up paying twice for that, and more expensive in the long run. So the poor man pays twice.
Yeah.
I think that's also really important for the infancy of a business as well, because you feel like you need to do it all, because like you said, at the start of the first 12 months, you might not have the income coming in where you feel like you can outsource certain things, but there's going to be a time where you've only got so many hours in the day, and you need to make a choice between you can go out there and, you know, get more clients or make more sales or advertise more product or whatever that looks like, or you can concentrate on your bookkeeping and trying to run ads on Google and all those other things. Is there a way or a time that you can then identify where you're going to get more value add by offsetting the stuff that you don't bring in income from the business, and then focusing on that aspect of it?
I think it comes down to working out, say if you're in the service business, you charge yourself out at what, $300 an hour, and then you're still trying to do something else at a lower rate. Instead, just why don't you go sell for another hour and then pay someone else to do that and still have money left over?
Knowing your numbers.
Yeah.
Probably should see your accountant. Or get a decent accountant.
Yeah.
I think we always underestimate the impact that bringing in a great person to your business can have. So that to some extent you got to look at the numbers and make sure they add up, but it can always feel like an insurmountable leap when you're going from a one person or a two person business to add that second or third person, because you're doubling, right, in that first step. So it never quite, you're not going to have enough income to do it initially. It's a leap of faith. But if you pick the right person, you'll be surprised how quickly the numbers catch up.
That leap of faith it's hard for people. And I was only speaking to a client of mine today who runs a cracking business. He's been running it for 6 years. Had a call today that he's picked up another couple of contracts. You know, he's going to order $80,000 worth of equipment, but with that, it's an $80,000 cost. Plus he also probably needs another track, which is $300,000. I'm like, mate, you need to put an ad in the paper for a manager. I don't know how you do this. And he's like, should I be doing this? And I'm like, just stop, just talk me through the numbers. And we just went through it. And I was like, you know, your business has got the potential to make $250,000 on profit each year. You've just retired your mum. How good are you going? You know, stop it. You're so good at what you do. Now just try and bring someone else on to keep going. But it's hard. It can be very hard and can be very nerve-wracking to take that leap. And as you're saying, is just take it.
Yeah, and back yourself.
Back yourself. Brad, Andrew, thank you for coming on. We've got, to finish off, we've got 5 questions or fast 5 that we'll go through with you both. A little bit of
Rapid
fun.
fire,
So
okay.
Rapid fire.
No thinking, just go.
It's not always been in my
You want to go first, Brad?
No, one from each of you, I reckon.
Okay.
Is there an everyday mantra that you live by?
No.
No, not really.
Perfect. Great. Start with the fast 5.
We better with prepared questions.
Yeah.
Yeah, we threw these in at the end so that you guys couldn't prepare for these.
Bit easier the next one.
Nah,
Yeah.
we just have little goals. Like we always say goals, but I wouldn't say an everyday mantra. That's like what Andrew's talking about, doing the little 1%. If you set out 5 or 6 things you want to do through the year, and then by the year you've done them, it's like, sweet.
How good are we going?
Call that your
Oh.
mantra. Tick off your 1% every day. Hey?
Yeah.
I'll say people first.
Yeah.
Mantra.
People first, I love it. How do you unplug from the numbers?
Never. And unplug. Why would you want to unplug from the numbers?
For me, I love the people we look after. So it is hard to switch off. It's not necessarily about the numbers, but I also get excited when the clients are saying, oh, I've just booked a trip here, or I'm going there. I love to travel. So when they tell me about that as well, get us talking for hours.
A show or a movie that you've loved lately?
Started the new season of The Bear.
Yeah.
Yeah, I love that show.
Oh, I haven't watched TV recently, but people have been telling me about the podcast with the mushroom
Or the lady?
Mushroom trial.
Yeah,
Really?
a couple of the girls in the office have been following that on a podcast, and they're starting to believe he's
Guilty? Not
she's
guilty,
not
Brad.
guilty.
She's not guilty.
Yeah.
They
Wow.
reckon that's
What's your
the case.
call?
For her.
I haven't followed it properly, but I still think she's guilty. It's like, how the heck? Some people get it and some people don't. That's what I don't
the
work
kids
out.
weren't there and stuff.
Yeah.
Oh. What's your inspiration to be successful?
I do it for my kids.
Yeah, I like that. It's that freedom. People want profit, but most people want freedom to be able to go. I love being able to go to my kids' athletics carnival awards thing, do that. We want that for our team as well. So it's just like family first.
I love that. What's one thing that you wish you knew 10 years ago?
Buy 0 shares.
Good accounting software.
Some people knew that.
Yeah.
That's not financial advice either.
No, it's not. It is not financial advice.
I think 10 years ago, we focused more on what the vision for where I wanted to be, rather than only aiming 1 or 2 years ahead. Eyes up.
Eyes up footy.
Eyes up footy. Yeah, we've got a little mantra on this podcast that we talk about is look long, play short.
Okay.
So always looking out in the distance. It's a little bit of a football analogy, but you're always looking long, playing short. So where do we want to get to, but what do we need to be doing today to get there? Yep.
Brad, Andrew, thank you so much for your time and coming in today. We really appreciate it. And there's some great little insights there. So thank you once again.
Thanks, guys.
Thank you. Appreciate it.
Honoured to be here.
Thank you for tuning in to Your Wealth Playbook. If you're watching on YouTube, make sure to like and subscribe. If you're listening to Spotify or Apple Podcast, hit follow and drop a 5-star rating and share this episode with a friend.
Help us reach more people and enhance the financial knowledge of our families, friends, and communities. Have a great day. We'll see you next time.